All right, so far we've covered payments and payables, revenue and receivables, and expenses. Now, just to clarify, expenses are also part of payments and payables, because when you pay your expense right away, you're actually going to forecast for that. But you also need to forecast for things that you may take on credit, i.e., from suppliers, and pay in the future. That become a payable. It become a short-term liability. And revenue, as we said, can be cash or can be on credit, can be debtors. Yeah. So debtors and receivables are the same thing. And expenses that we've been discussing have quite a lot of different types of expenses, right? We got income expense or revenue expense, which is operational expenditure basically, and we got capital expenditure, which I'll explain more about shortly. And now we're on to dividends. Now, dividends here is a cash outflow. That is effectively where you are actually paying back shareholders. The business is paying back shareholders. Now, according to the profit first system, which you obviously been through, as a business, you should have 5 bank accounts, right? So you should have the income account, which is the revenue account. You should have the expense account, yeah, operational expense account. You should also have the profit account, the profit first system. You should also have a shareholders account, and you should also have a tax account. Now, the shareholders account or the director's remuneration account can also include dividends. As a director, you can pay yourself in salary, but paying yourself in dividends also helps you to save taxes, because the tax rate on dividends tend to be lower than the tax rate on salaries, especially in the UK, right? So effectively, dividends is a share or percentage of the profits for the year. If you are the only shareholder, you're entitled to 100% of the share of the profit, right? If you have a big company, you have to obviously divide it according to shareholders, right? And you may have a board meeting for that and decide that. Now, this is different to you receiving income from other companies, which is called investment income, which you're going to come on to shortly. This is literally a cash outflow that you as a business owner need to plan for. The investment income or interest income, it's a little different because investment income is when you invest, okay, and you get dividends, i.e., when you receive dividends. Yeah, you have interest income is when you also invest, where you can also put money on deposit and you get interest income. Or if you invest in certain unit trust, or if you invest in bonds, you get interest income. Okay, as we explained some of this in the investment section. So effectively, investment and investment income you can plan for if you have investments. So for example, if you do real estate investments, if that's what your business is, then you have to plan for how much investment you're going to get. If your business is just investing for returns, you have to plan based on your investments, how much investments you will get over time. Okay. Effectively, investment income is the income generated from the interest payments, dividends, and capital gains collected on sale of a security or asset, and other profit made through the form of investment of any kind. And when we say capital gain, what do we mean by this? We mean that if you, for example, invested in a property and over, say, 5 or 10 years, the property went up by, say, 100,000, and then you sold the property, that's like a windfall income. It's a capital gain. Okay, so that's also an investment income and interest income. Yeah, is collected from the sale of assets. So investment income is really important for small business owners. And if you understand the Robert Kiyosaki cash flow quadrant, effectively you can earn money as an employee, you can earn money as self-employed, you can earn money as a business owner, and you can also earn money as an investor. When you have an investor, your money works for you. All right, your money works for you. You don't work for money. That's a big difference between an employee and an investor. I really like investment. And there are different type of investment income, as we said. Some of these, interestingly, or has interest, and some has dividends, like bonds or fixed income securities pays a dividends. CDs pay a dividends. Trusts pay a dividends. Yeah. Sorry, excuse me. They pay in interest income. They pay interest income. Yeah, but there are some stocks that pay a dividend. Mainly, when it says stocks, we mean equities. Equities, companies pay dividends. But when you invest in shares, you get dividends. When you invest in bonds, you get interest. Excuse me, I mixed that up earlier. You have to excuse me. Also, as you may know or may not know, you can invest in properties indirectly through funds like REITs and REIFs. Yeah, you can invest in properties indirectly through funds like REITs and REIFs. Okay, let's move on. So interest income is the amount of interest that you have earned during a specific period. Now, remember, you want to plan this, you want to predict this, you know your investments, you want to predict this. Now, some income, like interest income, is easy to predict. When it's dividends income or dividends that you receive, although in this model it's badged under interest income, you never really have to you will not be right about the amount to predict because it depends on what the company pays out. All right. So investments that pay interest are more like savings account or CDs or, as we said, bonds, etc. Right. And that's the main thing. Or also, you can charge interest as well. You can charge interest on customers. If sometimes like the Inland Revenue, the government actually charges people interest if they got late payments. You can do the same on your customers. That become interest income. So I've been talking about capital expenditure for a while. I know we're on to capital expenditure. We are moving forward in this cash flow prediction model and now you kind of get the idea of the system actually works. We go through payables, revenue, expenses, dividends, interest income, capital, and right. So capital expenditure is long-term expenditure. It's effectively when you're buying assets or equipments, and you're obviously going to plan for this. And the only reason that you're going to buy equipments or assets is to get money, is to actually get a return on the investments. Yes. So it's called a capital expenditure. So you will plan to buy equipments, you will plan to have capital expenditure on the basis that you'll get some returns for your investments, right? So a capital expenditure refers to the expenditure incurred for an asset that is expected to provide some form of income generation to a business for more than a year. And it goes on the balance sheet, is effectively an asset. Yeah. And we said earlier, you can depreciate it over time, but depreciation is a non-cash flow expense, right? So typical capital expenditure are building, computer, office, furniture, land, machinery. I mean, software as well, yes, but you can also have intangible assets, vehicles as well, right? So as I said, intangibles can be things like patents, etc., that goes on your balance sheet, yeah, that you may have to pay for to acquire. Okay. It's a bit of a deep into cash flow prediction model, but these are all the things that if you really want to predict your cash flow properly, you have to think about. You have to plan. When am I going to buy some more equipment? When am I going to maybe move buildings and all that kind of stuff? I move office buildings, etc. Right? You got to plan for these things. Maybe you're a small business owner, you want to buy some office equipment, as I said. Maybe you want to buy computer equipment. You got to plan for this. All right. Now we're into taxation. Now, taxes, interestingly, many small business owners do not predict the taxes and they don't know how much tax they're going to pay at the end of the quarter or year. I mean, if it's VAT, it's a different thing, but even VAT, some people from a cash flow perspective, they struggle to pay the VAT, even though the VAT is not their money. When you have VAT, you basically collected monies on the behalf of the government. Of course, you can offset your expense, VAT and expense against the VAT from income. I'm talking about corporation tax here or other taxes, tax on profit. You know, more small business owners who I've worked with don't plan this. So it's very important to actually plan your taxes. Okay. For example, if you receive dividend income as well, you may also have to pay taxes as well. Okay. So taxation is basically, have you paid your taxes? When would you pay your taxes? You have to go, you got to plan for this into the future. You got to predict it, and there are formulas for this actually. If normally like in any country like 20% or 26% or whatever it is, so you can if you're using a profit for a system, you know what profit you make anyway, and if you know what profit you're going to make for the year, then you already can predict your cash flow. Simple. That's why the profit for system is very very good to implement and use. All right. We all know what taxes are. We cannot get away from tax. Apparently, the only two things that are sure in life is debt and taxes. You must pay taxes. You must pay taxes. Which remind me, actually, I've got to pay up some UK taxes. I'm currently in the Caribbean at the moment, but I've got to pay some UK taxes. We've got income tax, property tax, and we've got tax on goods and services like VAT. You also got taxes on income, as I said, like payroll taxes, yeah, like NIS, etc. Then we have capital gains taxes, like if you sell a property, as I said earlier, you have capital gains taxes, estate taxes. If you die, you have to pay taxes. You got property tax, you got real estate tax. Taxes, is what keep governments going. So taxes is a big thing you got to plan for, right? They're very, very much. They're different kind of taxes depending on where you live. There's even road taxes, like in the UK. Seriously, you got vehicle. There's vehicle taxes. There's so much taxes you got to really plan for, right? Plan for your taxes. Don't be caught with your pants down, right? So effectively, once you have all of those income and you have outgoings, you're actually going to total them up. So you're going to have your total incoming cash flow. You're going to have your total outgoing cash flow, and then effectively you're going to have a net cash flow. That's effectively what a cash flow statement is about. I hope that makes sense. Your net cash flow is basically really, really important because you got to keep a watch on your net cash flow. Because your net cash flow is all of the incoming cash flow minus the outgoing cash flow, and you actually want to have some triggers. Like if you're using spreadsheets, etc., you can actually put some conditional formulas to flag up. If you have a more complicated system, you can have an email system that triggers you if the cash goes below a certain level. So these are things that you really, really, really want to plan for. All right. As I say, you want to track it. You can put in your calendars with certain things. Like you want to schedule your tax payments. You want to schedule certain like reorder levels for stock, etc. There's many ways to track your cash flow. You want to schedule when people owe you, or I speak like Caribbean people sometimes. You want to schedule your debtors when people have buy things for your credit. You want to schedule that and collect it. You want to really track your cash flow. And you can use many, many different systems like Plan, Guru, Float. QuickBooks is really good. Pulse is good. Google Docs is good. Just to track your cash flow systems. All right. Really, really, really important stuff here. Tracking your cash flow so you never actually run out of monies. All right. And as I said earlier, I think a recent study shows that 80% of new businesses fail due to poor financial planning and cash flow management. That's why tracking cash flow is very, very good. So basically, there's an exercise for you to go and do a cash flow projection. Of course, this is John and Jill's Homemaker Business. You're going to do this exercise. I got some information for you here. They are experienced interior designers and effectively they're in partnership. Each invests in 5,000 in business and all that kind of stuff. It give you some transactions, some revenues, give you some payments, and it give you all the different payments over time, including capital expenditure, which we've been discussing, operational expenses, day-to-day costs, and you have got to prepare a cash flow statement literally with investment, the credit sales, the materials, etc. Have all the cash inflows, have the cash outflows, the net cash flow, closing balance. Okay, closing balance is of course opening balances plus inflows minus outflows. It's a closing balance. Now I'm going to give you this in a PDF document. But really and truly, I might even try to, if you really want to get this done by Excel, you can always email me as well, roy@mmmedia.co.uk, and I'll give you the Excel version. All right, I'll leave the action with you to do that. That's a cash flow forecasting, actually. Effectively, as we know, if you don't have a good liquidity and you don't have good cash flow, you can run out of business. And there's several factors to consider, like overstocking. Overstocking means that your money is tied up in your monies are tied up in stock. Over borrowing means that basically you can't pay back your loans. Yeah, unexpected changes like COVID, for example. COVID came and wow, people didn't expect not to get revenues in. And therefore, even Richard Branson of Virgin, he had problems. And it results in poor credit and not so trustworthy. So cash flows are really, really important to really manage in business. All right. And yeah, there's many, many things that to look out for, like over trading. Like if you expand too quick and you don't have enough working capital, that can be a problem. Yeah, even production. Depending on if your business cannot recover because I don't know it has a bad batch. You know what I'm saying? Yeah. Or it takes a long time for someone to purchase your goods. That all can be a problem. So how to track, as we've been discussing earlier, you want to prepare a forecast. Yeah. A firm, you want to prepare a forecast. Okay. And some people actually they make mistakes and assumptions when preparing the forecast, and there's no guarantee that all the expectations will be met. So therefore, it means that you really got to keep up to date with it, right? So cash flow has to be continuous and ongoing. It's not something that you can just do and leave there. You have to keep updating it. Yeah, you have to constantly check on the cash flow position, identify problems before they happen. Otherwise, you may actually find yourself in liquidity crisis. Okay? So cash flow management is not just something for new companies, by the way. It's also something for every business to take seriously. I want you to take cash flow seriously. And your responsibility as an entrepreneur is that you need to ensure your company is not spending more than it's making unless it's a new business, yeah, with a promise of returns later on. And even then, the outflow needs to be planned for and funded. That's your responsibility as a business owner. So effectively, we've come to the end of this section. We come to the end of the cash flow prediction model. As I said, it's your responsibility to manage your cash flows because failure to manage your cash flow can result in business collapse. All right. So hope you enjoyed the section. I hope you enjoyed the training. And until the next section.